All right, so last time we talked all about assets. Today, we're going to flip the coin and look at the other side of the balance sheet, liabilities. You know, to really crush the CMA exam, you've got to understand not just what a company owns, but also how to put a precise value on what it owes. So let's dive in and break it all down.
First things first, let's start with the official definition, right from the CMA syllabus. A liability is a probable future sacrifice of economic benefits. Okay, so what does that actually mean in plain English? It's basically a promise to pay. It's a debt that the company is pretty sure it's going to have to settle by giving up something valuable, and that's usually cash.
But that definition brings up a really interesting question, doesn't it? I mean, how do you put a price tag on a promise? If I promise to pay you $1,000, but not for another 5 years, is that debt really worth $1,000 on my books today? The answer is a big no. And the whole reason why is something called the time value of money. And let me tell you, this concept is absolutely central to figuring out what a company truly owes.
To start making sense of all this, the CMA exam breaks liabilities down into what I like to call a tale of two timelines. See, the first big distinction we have to make is super simple. Is an obligation due soon, or is it due way out in the future? And believe it or not, that one single difference completely changes how we calculate its value.
Okay, check this out, because the logic here is really important. For current liabilities, we're talking things like accounts payable that are due within a year. The time frame is so short that the effect of interest, that time value of money, is usually considered immaterial. It's just not worth the complicated math. So we simply value them at their settlement value, the full amount we expect to pay. But for long-term liabilities, time matters a whole lot. For these, we have to calculate the present value of all the future cash flows, which takes into account both the principal and all the interest payments over time.
All right, take a deep breath. We're about to tackle what I call the final boss of liability valuation on the exam, bonds. This is where so many students get tripped up, but I promise, if you can really master the core concepts here, you are going to be in fantastic shape. The whole key to understanding bonds is to see it as a battle between two different interest rates. You've got the stated rate, which is what the bond promises to pay. Then you have the market rate, which is what investors out in the real world actually want for that level of risk. If those two rates are the same, simple, the bond is issued at par for its face value. But what if your bond's stated rate is lower than what the market is offering? Well, nobody's going to pay full price for a worse deal, right? So it has to be issued at a discount. And if your rate is higher than the market, now you've got a hot commodity, and it'll be issued at a premium. Now, here's the golden rule for the exam, the thing you absolutely have to remember. The value of that bond on the balance sheet is not its face value. It's what we call the amortized cost. Just think of it like this. The bond's book value is slowly correcting itself over its life. Whether it started at a discount or a premium, with every interest payment, its carrying value gets one step closer to its face value, which it will perfectly match at maturity.
So we've covered the definite promises, like bonds, but let's move into the gray areas. What happens when a company might owe money, but it's not a sure thing yet? Like an ongoing lawsuit. We call this a contingent liability. It's an obligation that depends or hinges on something happening in the future. So how on earth do we value something that may or may not even happen?
Well, lucky for us, US GAAP gives us a really clear decision tree to follow. It's a two-part test. To actually record a liability on the books, two things must be true. The loss has to be probable, meaning it's likely to happen, and you have to be able to reasonably estimate the amount. If the loss is only, say, reasonably possible, you don't book it, but you do have to disclose it in the footnotes. And if the chance of losing is remote, you just do nothing. Knowing that sequence is crucial for the exam.
And here's a little detail that the exam absolutely loves to test you on. What if your lawyers say the probable loss from a lawsuit is going to be somewhere between, say, $1 million and $3 million, but they can't pinpoint an exact number? US GAAP is very, very clear here. You have to record the minimum amount in that range. So in that case, you'd book a $1 million liability on your balance sheet.
So we've talked about present value for long-term debt, probability tests for contingencies. These rules might feel a little disconnected, but they're not. They're all tied together by one single, powerful, overarching accounting concept.
And this is it. This is the why behind all the rules, the principle of conservatism. Basically, accounting rules are designed to make sure companies don't understate their liabilities or overstate their assets. The whole goal is to give a realistic, even a cautious picture of a company's obligations so that investors and creditors aren't misled. It's really all about not hiding the bad news.
So as you keep studying for the exam, I want you to focus on this one core question. The examiners love to test the difference between a liability's face value and its carrying value on the balance sheet. If you can clearly explain why those two numbers are so often different, you're not just memorizing rules. You're showing that you truly understand the concepts, and that is the key to mastering liabilities. You've got this. Keep up the great work.